You want an investment edge, but all you hear is noise, hype, and half-truths. Every signal is solid information, but only if you can see the bigger picture. This is where the Quasar magic happens. Weather, charts, news, all financial signals, funneled into a single dashboard. Data alone isn't enough. Quasar Markets turns it into energy, sharp, clear, precise. Optimize with Quasar Markets today. Your edge when investing.
Boom, we got a good one today for you, Jim Iuorio, straight from hot Chicago. Talk to me, Jim. There's a lot going on, man. All the way down from the president. Yeah.
Well, first of all, before we get to that, I think this is a huge day. People are watching this live, right, Steven, on Twitter?
Yes, they are.
This is a big day. If any of you guys watched the Unfiltered Investor podcast yesterday, we talked about the line in the sand, which was 63.85. Now, if you go back a week ago Monday, the pattern that existed before the fateful unemployment day was every day the stocks were higher and every day they finished lower, 4 straight days. Then we get to Thursday, Amazon posts arguably excellent numbers and gets the crap beaten out of it. Then comes Friday, which we think, okay, are we closer to recession than we thought we were? Yes. Is the Fed going to ease? Well, they have 6 weeks before they can, or else they're going to look panic. So I thought the stock market was weak, but then all of a sudden it started coming back this week, but it needed to settle the day above 63.80. It started the day comfortably above that level, and that's bled away. And it doesn't look, I think this is going to look like a big failure. And I think that means probably a test of 6,000 on the downside. I think today is very, very key price movement. Does that make good sense?
Yeah. What do you need to see with that move? Do you need to see some more news? Trump saying something silly? Do you need to see some deal? What do you need to see? Yeah.
For the down move? No, I think all you need to see is, it's Trump. Yeah. Like I made a joke yesterday on a show. I talked about how copper was kind of an uncomfortable long for me. I had more of it than I wanted to, and I was considering getting out of it or hedging it. But fortunately, that problem took care of itself all in one day. That's a losing money joke if people aren't paying attention when it went down 30%. Again, Trump is the human headline bomb, and he can move markets at any point in time. Now, the funny thing is that you and I both have been watching markets long enough that we know that market position gets to a certain point that the same headline might have a different effect one day as it would another. And right now, I think from all those things we mentioned, that the path of least resistance is lower. So it might just be, an innocuous headline. It could have been an innocuous headline a couple of weeks ago, but now it'll hit home and push markets lower. I think provided we get that weak close today that I think we're going to get.
Yeah, for all you out there, if you just heard what Jim just said, the path of least resistance. When I talk about the path of least resistance, this is what I mean. This is an old trader's comments, and you heard it right from it. This is how it happens, right? Jim, the markets, the institutionals are more short now than ever in history. The amount of money that's in the markets on the short side. Short squeeze, a little bit of concern there too as well?
Certainly. When I see that, what that means to me is not that we can't correct, but just that we probably can't correct like a nasty 10 to 15% correction. To me, it seems like that means that we could do a 4 to 6% correction and everybody lives happily ever after. But here's the one thing I thought at the beginning of this year, and tell me if you think it's crazy or not. And it involves what you just said about the net shorts. I think bear markets and deep, brutal corrections are born of excessive complacency. Well, you have Donald Trump in the office, if we've already established as the human headline bomb, and he can bring volatility into the market anytime he opens his mouth. And spoiler alert, he does do that. So I think that could make the market more durable to the upside. And all these shorts are probably positioned for the rocky path that 2025 was supposed to be. And it is in some ways being with, anytime you go from one economic system to another, you have to assume that it's going to be an inelegant and clumsy sort of transition, whether it's bad to good, good to bad, or whatever. I happen to think it's bad to good, but that's just one man's opinion. But even though I think it could be rocky, and that's why I understand some of the shorts, but the counter to that is if there's tons of shorts in the market, then they will be crawling over each other to cover at good opportunities, which that could be 3 to 4 to 5% lower.
And I agree with that. And what's interesting is you said all this in the Unfiltered Investor newsletter, and I put it out there for everybody to click on. Click on that button, then the Unfiltered Investor newsletter through the Beehive. I love this newsletter because you don't pull any punches. I heard Mooch earlier today. I was just on the phone with him, calling Trump an asshole. the thing about us as big investors, as people who've been in the game a long time, is that we don't really pull any punches, right? We just tell people the way that it is. We're not the talking heads that you expect. And a lot of times we've seen, Jim, over the last few weeks, a lot of this noise has been just noise because it's been the summer, because it's been the doldrums. And in the past, and I have to ask the question this way: when does good news become good news, and bad news is bad news, and bad news is good news, and good news is bad news? What area are we in right now with all this noise?
So right now, I actually think good news is good news. And
Yeah.
mostly that's because we have what's turned out to be a hawkish Fed. So you can argue that Jay Powell's being political and he's being forecast dependent and not data dependent like he claims to be. And I will agree with you on that. But either way, he's more hawkish than he should be. Now, if we're starting to price in Christopher Waller, then we could conceivably be pricing in a dovish Fed, which would mean that bad news isn't that bad and stocks could rally off that. As a matter of fact, I think the earlier rally this week, and I know it's having trouble today, and I said what I said about the rally, but one of it was that we were starting to price in Chris Waller as the new Fed chair, and he's come out publicly and said that he thinks Fed funds should immediately be 3%. Well, that, in my opinion, is idiotic. I think they should be lower, but I also think that you can't risk the market thinking you're going to spark inflation. I'll say one thing real quick is that back in September, when they cut by 50 basis points and 10-year yields screamed higher, that was an instant report card on the Fed's move. And what it said was your move is too quick, you're going too fast, and it's going to cause inflation in the longer end. Now, when a couple days ago, Friday, when we saw the unemployment numbers, which were disasters, and we priced in eases on the short end, an extra 25 basis points this year, almost an extra 25 basis points, 10-year yields went lower. So to me, that means that that's a green light. The 10-year is saying, yes, you should be lowering rates and you should do it soon. But now if you and I were in charge of the Fed, we'd lower 25, maybe at the outside 50. We'd hold our breath and watch the 10-year because it will grade us in real time. If we think we can get away with it and not spark inflation, then and then only is the door open to more aggressive cuts.
Yeah, and I love this. I believe that 3 months ago, I called Chris Waller to be the Fed chair, and he's a St. Louis boy, Jim, I might add.
Really?
Yeah,
He's probably
St.
a
Louis
Cardinal
Fed.
fan, so I got to hate
He
him.
is, actually. I know that for a fact. Look, and, you know, he is a Trump supporter. He's calling for the rates to be lower. But let's push this forward with Chris Waller. This is the guy that brought Fred better data to the markets. And, you know, I think Trump's really got a good pick here. He's getting everything he's asked for, right? So if he gets right.
And
so
I'm not saying Larry Kudlow yelled at me on Saturday because I'm saying Chris Waller saying that he wants Fed funds rates at 3% today. That's a wink and a nod to the president saying, pick me, pick me, pick me. I think it's slightly, very slightly unbecoming and undignified.
Yeah.
However,
well, the knee pads are only so big, right?
Exactly.
I mean,
that being said, I do agree with you that he'd be good at it once he gets it. I think he's posturing for the position now. But spoiler alert, I would do the same damn thing and then know that I was being undignified as well. So I don't even fault him that much for that.
But don't you think that's a little bit self-grandiose? Because quite frankly, everybody that Trump picks usually leaves the orbit. I mean, Trump picked Powell.
That's a secret.
I mean, hello. I mean, with Waller, you're hearing now a lot of the Fed saying, we're cutting. And we had one, Angela is leaving for personal reasons. He's got 2 picks now. So this Fed's going to get really lopsided to cutting rates here.
Yeah.
Will this help the housing market?
Well, it should. I think when we talk about recession, I know Mark Zandi came out yesterday and said that he thought we're going into recession. And I tend to agree, not as strongly as he is, but it's because of labor. Labor market looks bad. And it's because of housing. Like you said, we created the most odd housing market probably in history with the rapidity that we took mortgage rates up from 2.5% to 7.5% in 10 months time. And what we found that it did was lock up supply, and it locked it up for years because nobody wants to part with their 2.5% mortgage. So now if rates start to come down, I think, and this could be paradoxical, I think initially it could free up supply and depress housing, but then eventually demand will eat that up. Demand's still out there and will eat that up. But in the short term, I think lowering rates, which is necessary for the housing market, because there's only one way out of this situation we're in, that's have lower mortgages, supply comes to the market, but then demand over time has to eat that up. This is not a problem that's going to be fixed in a month.
No, and you're seeing the most homes ever on the market in history, but yet prices of homes are still kind of holding up in a lot of ways with the anticipation, right?
Right. And that's the procedure that it normally does. Inventory increases. But remember, in housing, do you remember back in 2007, 2008, you could talk to people till you were blue in the face and they refused to acknowledge the fact that their house was down 20, 30, 40% in value. They absolutely refuse because it's just something that's so foreign to them. And that's what we see in the housing market right now. People come in and like, yeah, it's probably time we sell our house. And right now,
but Jim, we're not seeing in 07, 08, people were throwing their keys at the front door because they're upside down in it. We're not seeing that now, right?
No, definitely not. And I'm talking about at first in 07 and 08. Because then when the job losses come, you have to sell your houses. And we have not seen the real job losses yet. And that, again, is a function of we had a labor shortage for 2 years, 2 short years ago. And I think larger companies are still wearing the scars of that. So I think it's
it's going to get worse with immigration, right? I mean, it's getting worse now.
Should get worse now. Yeah. It's the immigration thing is going to have serious downstream effects that I don't think most of us really understand yet, including myself. But the labor market could be a big, could be punished because of that.
Let me ask you the last question before I let you go. You're looking at the markets from different perspectives, meaning that the commodity markets should 9 times out of 10 doesn't always follow the NASDAQ, and the Qs don't always follow crypto, but sometimes does. There seems to be this correlation right now of the whole market moving up or the whole market moving down. Is this mass money movement because of institutions fighting retail, or what's going on in the markets?
I think a lot of it is passive investing. I think that, you buy, people who buy, they used to go like, what am I going to buy? Now they buy the SPY, now they buy the QQQ. I think part of it is liquidity driven trade too. Remember, M2's gone to all-time highs very quietly over the last year. So there's a lot of liquidity in the market, which kind of lifts all boats. But correlations, as you say, are tight, and that's not a good thing on balance. No. I'd rather see stock pickers, but that's not the world we're in right now. I think passive investing and liquidity has driven it to a highly correlated market.
Yeah, and I just made a post about that, the marshmallow. I call it the marshmallow trade, which is the old Stanford 1970s thing with 1 marshmallow, 2 marshmallows. All right. Well, Jim, I appreciate you coming on. I know it's hot as hell in Chicago.
Hot as hell. I just walked the dogs, and I had my jeans on because I was on the trading floor before, and I literally sweat was rolling down my entire body. It's got to be like 95 and 100% humidity. I'm probably being hyperbolic, but I do that sometimes.
The hyperbolic Jim Iuorio. I love it, man. We'll see you next week, Jim.
See you.